Okay, guys, last video we talked up to equities, and now we're going to move forward into bonds. Now, the bond market actually dwarfs the equities market, even though the equity market gets all the headlines. All right, so bonds are basically a loan of money to either a government, a business, or other entity for the promise of return of the principal. So whatever I loan them, I need to get back plus interest along the way. All right, so the areas that we're going to focus our attention on, the easiest ways or lowest risk ways to invest are in government bonds. Government bonds have a risk-free rate. That's risk-free of default. That does not mitigate any risk of inflation. So there's always risk whenever you have an investment. And its main risk is if inflation is at 2% and you're only earning 1%, you're actually losing money, even though the value of the number of dollars you have is greater, their buying power is lesser. Okay. Now, government bonds can be broken into different uh, time maturities. So your shorter term ones are actually the very short ones are T-bills, and they can be 3 months, 6 months, things like that. Now our treasury notes are a little bit longer. They're in the like 2, 3, 5 year range, and then our bonds are referred to as like our 10-year or our 30-year. Those are the main ones that we're going to look at. Now the 30 years should carry a higher interest rate than the shorter ones, okay, because you're taking more risk. But sometimes the markets can do weird things and you can actually earn higher interest for shorter term than longer term. We'll get into that in later videos. The next area we're going to talk about are municipal bonds, and these are going to be state or local government issued bonds. And they're a little bit riskier, but they're going to carry uh, different types of benefits as well. So municipal bond is going to be free from federal taxation. And in some cases, if you buy a municipal bond in the state where you live, it might be free from both federal and state taxes. Okay. And we won't get into it in these videos, not this year, but we'll get into something called tax equivalent yield. So I don't need to yield as much from a government bond um, because I'm not being taxed on it. So I basically anything that I receive from the municipal bond is take home. There's no tax that's going to be taken out of it. Now, government bonds are free from some state taxes and local taxes, but they are taxable at a federal level, and the federal level's got the higher tax rate. Now, the two types of municipal bonds you can get are revenue bonds or general obligation bonds. General obligation bonds typically are a little bit safer as they're paid back by the tax dollars that are collected by the municipality. A revenue bond, let's say an example of bonds were issued to build a bridge across a river, and they're going to pay for that bridge with the bond, and we're going to repay the bond with the toll that was put on either end of the bridge. So as toll revenue is collected, that money is going to go back to the purchasers of these municipal bonds. Okay, so they should be part of your portfolio when you're making up your bond position, because you're going to want, depending on the accounts that you have things in, government bonds, I would put in an IRA because any income that I get from that would grow tax free. Municipal bonds, I would keep in a brokerage account, which is not tax sheltered. Okay, there's no real point of putting a tax a municipal bond in a tax sheltered account. Okay. Now, mutual funds. This is what a lot of people will invest in their 401k or their 403b or even their IRAs. Now, mutual fund is professionally managed, and a lot of people pull their money. They all invest in, and the fund has to have some kind of purpose. So it'll have something called a prospectus, which will lay out its investment strategy. And there's so many you can pick from. You're going to really want to take your time to find the mutual fund that fits your needs. Now, there's a lot of different types that are were created. An open end means you're going to send money to the fund, and as new money comes in, you're going to almost create shares or get new shares issued at that time. A closed end fund means the all the assets in the portfolio are in there. Only a fixed number of shares were created, and if you want to purchase some of those shares, you have to buy them from someone who's willing to sell them. Unit investment trusts are a little bit more complicated. You should really do your homework before you get into one of these. Many of them are constructed to have a defined life period. Um, so it, if you don't understand the construction, I probably would avoid some of these because there's so many other options that are out there. ETFs are the growth area, but for me, even though I own a lot of ETFs, the market for ETFs seems to be saturated. There's almost too many out there, and there needs to be either consolidation or closing of a lot of them. But anyway, these are mutual funds that basically trade like a stock on a stock exchange. Now, in the above closed end and open end, many times if I open my account, send them my money, I may not be able to get that money back without penalty within, say, the first 5 years. Okay, so that's called a load, and exchange traded funds don't have that. Now, there are management fees on that, so the management fees or the expense ratio can lower the fund's performance. But you do have the ability to get in and out of this investment very quickly and easily. And it's almost worth paying for that freedom just in case something happens and I needed to sell this to raise cash for an emergency, and I won't be penalized for that. All right, now index funds seem to be where many investors who don't have the time to do a lot of research or homework, they look to track to an index, and the most popular, of course, is the S&P 500. The Dow Jones gets a lot of headlines, but it's really only 30 companies. 30 blue chip companies, so there's not a huge growth potential there. But the S&P 500 pretty much tells you about the health or the state of the 500 most mature companies in our economy. Now, when we talk about the market, I'm sorry, it's any place where investments are bought and sold. So there's a commodities market, there's a metals market, there's a foreign currencies market. There's a lot of different markets that are out there. So anytime they refer to the market, they're usually talking about the stock market, but there's also the bond market, which is, again, dwarfs the size of the equities market. Now, when we're looking to purchase either ETFs or stock or bonds, we're going to need a brokerage firm. Okay. Now, these are financial institutions that help you buy and sell securities. They're basically a middleman between buyers and sellers. Now, you have your Schwabs, your Fidelities, your Ameritrades, your E-Trades. There's some consolidation in that group because some disruptors that are coming into the scene, like for one, Robinhood is stealing a lot of market share and actually forced a lot of the older players to remove commissions on trades. And another one that's coming up that I'm starting to learn more about is public.com, but I don't have a lot to say because I just started doing my homework on them. Now, a bull market is is when stocks are steadily rising over time. So the way I remember it is bull markets charge ahead, okay, and bear markets, well, they decrease over time, and bear markets will claw or rip your eyes out. Now, the cycles that we're going through seem like they're one of a kind, but when you look at the patterns, we've seen this before. Okay, so we have a rise, we start to sputter a little bit, people are still buying the dip, we got a lot of enthusiasm, and then we roll over for whatever reason. Now there's panic. So like we saw this panic down in about March 23rd. That seemed to be the low. Like this graph goes even lower, but we we hit that low March 23rd, and it was a steady ramp up. And now it seems like there's a little anxiety right now where we could retest the lows. If we don't get back to that level, we could start a new bull market. Now, bear markets usually aren't that prolonged, and within bull bear markets, excuse me, you could have these rallies. So if you can stay nimble and stay light, what I usually say is if you're worrying too much, then that means you have too much exposure to the market. So you sell until you can sleep at night. But you do really want to buy when everyone is selling, and you do want when there's panic and when there's discouragement. That's when you want to be accumulating. You don't have to do it aggressively, but buying a little bit over time. And as you start to go up, you can lighten up and sell into the strength. So when everybody's enthusiastic, you want to be selling. Okay, so here kind of this is like the sine curve of the financial markets. So as we rise up, there's optimism, excitement, there's a thrill, everybody's making money, and a lot of people confuse a bull market with being smart. Okay, you are smart is if you're selling into this enthusiasm. As we roll over, the anxiety creeps in, and then eventually there's the selling. It's at that point where it feels like there's no reason to ever be in the market. That's when you want to start buying. Okay. And eventually there's going to be depression, but there's going to be a little bit of hope and rise in optimism. And you want to buy into despondency and sell into euphoria.